Okay, hello everyone, and welcome to our Summerwood Place quarterly update webinar. We've got Sam and Mark joining us today to run through their presentation. We expect it to be about a half an hour long presentation. And as usual, obviously, if you do have any questions come up throughout the presentation, just pop them over to your right in the chat box and we can run through them at the end. Otherwise, I will let Sam and Mark crack on with their presentation.
Yes, good morning, everyone. It's great to see the attendees. As always, finishing off a rather great year in 2024 for Summerwood Place, as we successfully implemented the lessons that we learned from 2022 and 2023 into creating much better returns in the portfolio, and in fact, having some rather great payouts as well. But that's 2024. Let's see where things go now. Just as a reminder of the format of these, there's a quick reminder of redemption processes and timelines, which Mark will go through in a second, as well as the process to wind the vehicle up and the timelines involved in allowing all loans to redeem if that were to happen. Before I then go into talking about the current situation and how our performance has been, what our performance is looking at like right now, as well as also a bit of a conversation in regards to the current loans and loan book and what the environment looks like moving forward into 2025 for new loans. We'll then quickly summarise going over, the option of borrowing in Summerwood Place, if that is right for our investor base, and how it affects the equity holders, as well as our options, the directors' options, in situations where there's a heavy request for an equity redemption or sale, just what the things are available to us to make sure that all parties are treated fairly, as well as finally a IHT refresher, and then we'll field questions as need be. Mark, did you want to have a go at a reminder of this, or is it a little bit too loud where you are?
We can try. Sorry, the later schedule threw me off a bit, but no, as long as the sound's okay. Redemptions. We I think it's been a good year since we've even had a redemption request. I think that sort of point of interest rates hitting their peak, and the only reason people came out Summerwood Place back then was a belief they were earning the same in a bank account, which got to the point of being close and level. But again, we reinforce this as a long-term vehicle where there's going to be times when rates come down that actually are Summerwood Place rates remain higher for a prolonged period. It took a bit of time for rates to catch up, and we still think it'd be the same on the way down. And certainly as a result, we don't believe there's any redemptions on the horizon. But obviously, yes, the point is just to always give shareholders the comfort that if anyone wants to reduce a holding, or we don't want any mortalities, but that may be the more common scenario where shareholding passes on to a beneficiary and they perhaps don't want to be a shareholder. So first point is right of refusal of existing shareholders. So once a request comes in, there's an immediate request sent out to existing shareholders, where existing shareholders can choose to buy those shares of the person wanting to come out, because perhaps they've been sat in cash, and it's a fast, efficient way of doing that. Perhaps waiting for another capital round. I think we're running up to our previous one. We increased the capacity by another 10 million. We thought that was giving us lots of headroom, but I think we're coming up against that. So if shareholders didn't vote to increase that, then there'd be even more reason to buy redeeming shareholders out, because it would be the only way to actually get shares. And that's a decision, that's shareholders' decision. It's not mine and Sam's decision on that. But yeah, we have that 3-week window where existing shareholders have the first option to buy those shares. They're usually bought at par, at what we believe to be market value. They're not necessarily bought as a discount, but perhaps if someone really wants to get out, there can be that negotiation, but that's not really. They've always just been bought at what we believe to be the fair value. After that 3 weeks, there's a sale sought to prospective shareholders. which, to be honest, whilst we're in that stage 2, myself and Sam would certainly be being conscious that we wouldn't be reinvesting heavily into new loans that came from capital redemptions, so that if we did have to move on to the next 3-week period, we would already be building up capital reserves that would do a share buyback to return shareholders' capital. As much as one has happened, I think most have actually happened through the second route. At the minute, we've got very good demand post the budget, with inheritance tax becoming an increased focus of new money coming in every week, either in the form of equity or loans. So, for those that, if ever wanting to come out, I would say we'll do the best we can in that route 1, but just because it's right to give shareholders a first option. But most are sort of being done in that sort of 3 to 4 week period when we realise no one's coming forward and we know we've got new money coming in, basically, and we'll match one off against the other. And yeah, hopefully that refreshes everyone on what is the likely redemption process. Of course, if we're sat there with bundles of cash, we may also just use that cash and make everyone's life easy, but that's the formal redemption process.
Yeah, thanks. And then in the event that basically the amount of requests coming in is exceeds 10% of the portfolio value, excluding the idle cash, we have the options to suspend new requests for redemption. The reason for this is it makes sure that we don't do anything such as, in essence, try to sell off the gold in the portfolio, so to speak, not literal, but the best, our favoured loans, in order to realise cash, in order to facilitate those redemptions. So we have our options in order to do that. If we do end up with more than a 10% request for redemption, a continuation vote on a business will follow. Should this vote result in a vote for cessation of a business, the directors, being Mark, potentially in the future a non-exec director, will undertake to redeem the shareholders out of capital as and when loan redemptions take place. And any interest payments that happen in the interim will only be paid out when a loan redeems. The majority of loans are 5 years or less. The longest has just short of 9 years remaining. So that shows the time period they would take for a full redemption. If there was a full wind-up of the business, not that we're looking for that to happen, and nor, as Mark has suggested, the flows are coming in rather than going out. We haven't got a single request for redemption at all, but it's important to be prepared and to be transparent and communicate this properly. If a vote is against the wind-up, then the directors can decide when redemptions can continue. This will most likely happen because equity holders have agreed on a new structure in the shareholders' agreements, or through a series of meetings with the management staff. So very, very keen for communication to be as thorough as possible. I think that's really important with keeping everyone happy. Okay, just looking at the rolling return over the last 12, 6 and 3 months. So we had an excellent Q3, which is why we see the 6-month return there being a rather lovely the equivalent of an annualized 7.23%. The last 3 months, although the dividend, as you know, was a little bit low for the last 2, was still coming in at an annualized rate of 6.1, with the dividend still being a reasonable amount there. On the 12-month period overall, comes in at 5.56%, and that's even with this really low last January figure there, which I know that we will exceed this month. So I expect that to increase even next month to a degree. And at the moment, it's looking like, as I mentioned in the email newsletter a week or so ago. Looking like at the moment February may turn out to be our best month ever for a dividend. But we need to hope that everything comes in on time with interest payments. Obviously, that if interest payments don't come in on time, then that will skew it. But if everything comes in correctly, February could be a really, really positive month.
And just a reminder, that's not us changing risk or anything like that. It's just we've got a bit of a bumper return of some of the accrued interest on various loans. One of the loans, I think, has had no interest for 9 months. It pays all its 9 months interest this month. So yeah, we're not doing anything different there, but it's nice to close out some of that accrued interest in what will be a very good month, as Sam says.
Absolutely. And just comparison, actually, fortunately, these providers haven't updated their figures since our last webinar, but it's still illustrative of the environment that they're in. With Puma, their returns for every 12 months were 3.3%, so we're well over 2% above, as well as Triple Point, 12 months 3.8 and 2.7%. So in that track with them, we are over double their returns. So we're doing really, really well from that perspective. And also just looking here, a few more in total. We've even had a competitor have a 12-month total return loss over the last 12 months, which being Octopus. So we have been managing to navigate this environment really quite well. 2.5% nearly above the competitor average there. So really quite happy with that. And just a reflection back to when we were, as Mark was saying, we were having those awkward conversations with clients because interest rates were rising and they were being offered.
So just one comment I was going to make there, Sam, just on that last slide, obviously just because on the advisor side, I'm closer to the debt panel that gets updated. So I think there's two factors in those excess returns. As I've said to every client as they've come into Summerwood Place, still feel greediness on the part of the providers taking excess fees out of what are fairly similar loans to what we're making. So there could easily be high numbers there, but they do have high fees on these funds. Are still an inefficient part of the market, and also me and Sam took what was, I guess, a kick up the arse at the time on some of the loans, even though we were quite happy to let them roll. But with that pressure of interest rates, we did a lot of good, in hindsight, transactions where we actually moved part of the lower yielding part of the Summerwood Place book, out of Summerwood Place into other structures and vehicles, and was managed to get that in pretty much top of the market into some of the sort of 9% tiered loans. So that was a particularly good portfolio management from Sam there. So yeah, we'll take a bit of a pat on the back, but also again I stress that we try to run this as efficiently as we can for shareholders.
Yeah, cheers. So yeah, back in the environment when new bank bonds were being issued, getting close to 6%. There were for a short period of time, and we were being compared. Obviously, we have a loan book that preceded that period. We've pretty much finished off that period though now. But on the flip side is when those rates come down with banks, we will still be sitting at this higher level. So the spread between what we can offering our shareholders versus what the bank would give you in probably 12 months will be a fairly sizable chunk difference. But going back to when we were having those conversations in July 2023, the most optimistic forward projection we kind of had was that we'd be looking at kind of like 5.49% compared, and we're exceeding that. So we're really happy that we've managed to implement that plan properly and deliver what we promised to you, in essence. Just a bit of a comparison here as to what the instantaneous yield is as of right now. What we see right now is that this is the big important rate down here. This is what in essence goes to you. We have increased slightly since the last webinar. The earnings return to shareholders up another 0.05%. So the now instantaneous total return is running at 6.4% for you. So that's very good. The loan book on average has a gross rate of 9.34%. And because we've been so active with money that comes in, whether that be for redemptions or new capital, we still have technically negative idle cash. So we've been really, really efficient. That's not to say that we have no cash. As I speak right now, there's approximately £200,000 in the current account. But the point being is that any surplus amounts are available to be lent out, have been. So we're being rather efficient at the moment. And if corporation tax hadn't gone up a couple of years back, that would actually be close to an earnings return of 6.68%. So getting towards 7% actually. So compared like for like, it's been a quite good environment. As I tend to do this, just for people that had once upon a time had prop-lend advisory accounts, just showing that the extra value that Summerwood Place has added on. We are currently returning to shareholders after corporation tax an additional 1.25%. So very, very healthy there in terms of the extra return that we are offering compared to just a peer-to-peer platform. And also, as we're talking there, being very, very efficient with the cash. At the moment, the average account has getting close to 10% of its account just sat in cash. So we're able to get those capital out the door. Well, did you want to quickly touch on the van lending facility? It's now fully drawn down, but I don't know if you wanted to just quickly touch on it, just as obviously it's been quite a big factor as to why that interest rate has, our returns has increased a little bit over the last 9 months.
You can put, you'll probably close to some of the stuff, but we increased that facility by another 200,000. They would have loved to have increased that facility more, but that 200,000 only came from new money inflows in and us being very strict on our capital to certain lenders. So communication with them has been good. They had the boost that they also had an equity round at the same time that we did this facility. It's kind of at the point we were making the decision on whether to do this, and I think they got a 600,000-700,000 equity round as well, which then essentially that meant there was. I mean, we know that they're going to burn that money trying to grow their business, but it was another nice factor to know that it wasn't going to be loan money that was going towards other things. The loan money was strictly for the vans, and that's how it's been. Sam and EJ as an independent person have been down to Woking to check all the chassis and things like that. So we've put time and effort into being as diligent as we can on this facility. And at the end of the day, if we get the sort of 14% or so plus a broker fee on that, then it's going to be a cracker. And I think that's just another example, Sam, isn't it? Correct me if I'm wrong, of one that's coming up to its or it may have just started its interest, monthly interest payments in. So dividends out, didn't get the benefit of that for the first 6 to 9 months, but I believe that holiday's over now. So we keep in contact with them just as we do with any other loan. we may do more in the future, but as I say, until the fund until the business and the capital of shareholders goes up, we can't really lend anymore anyway. So yeah, it's our most high risk strategy, but as far as we're concerned at the minute, has gone to plan.
Yeah, I think that summarizes it quite well. They've been paying interest monthly for the last 5 months. Next month is the first month of capital payments on top of that, which is nice because obviously ultimately vans are a depreciating asset. So obviously you want the amount outstanding on loans to be coming down alongside the depreciation of your security, and we're making sure that's occurring. They've been very active on the discount they've been getting on the loans, on the vans. It's been working quite well, and as Mark said, communication has been excellent, and that's a really important thing actually with when we're doing particularly direct inquiries, but we always ask it when we go through platforms, and we ask that of a prospective borrower is how active are they with their inquiries, and you tend to find the ones that are more quiet are the ones that you tend to have a bit more problems with in the future. So that's been dealt with quite well. I don't think I will talk too much about borrowing in Summerwood Place. Just I don't think it's necessarily. We've gone over it several times, and the people on the call are pretty familiar with it. We have started taking loan capital in now, so we are borrowing a little bit, but on circa £12 million of AUM, of value of the business. There's only about 200,000 is borrowing in, but that's being borrowed in at 6%, and it got lent out pretty much the same week at 9%, on a 65% loan to value book. Bridging loan. So that will tie up quite nicely, and it has certainly helped add a little bit more into shareholder returns. The general environment for 2025, how I'm looking at it at present, following all of our obviously continuous research, is we will probably see a bit of a drop down in our appropriate benchmark gilt interest rates. So for the 5-year government gilt will come down a little bit. But the one thing that is being very closely monitored is the risk premium spread. So as you can imagine, a loan out to me or you, how banks price it is whatever they can get from a government gilt, and then the rest that they charge you is a risk premium. That is very tight at the moment, so risk is in essence cheap. But I can see that widening out through the course of this year, which would be positive for us. Where it tends to find that certainly the residential bridging loans and the commercial property loans, they are on the lower end of where I'd expect things to be at the moment. I can see that opening up by at least 0.5% towards the end of the year. So that would be quite good in comparison to what a bank will give you, because obviously a bank is comparatively low risk borrower. So when they lend money out to you, it's quite cheap in comparison. So we can do that. Mark, did you just quickly want to go over the difference between equity and lending, and a quick IHT refresher on the next page?
Yeah, that's absolutely fine. So yeah, obviously the originating and most common structure is via the equity shareholding. For anyone doing this with possible business relief intentions in the future, that still remains the same. We did introduce the loan note, partly for someone that wanted a bit more of that just wasn't driven by that style of investment, and we realised that we could lend money we could take money in on a loan a rate higher than what a bank or someone else would offer someone. And yeah, based on our running average, lend it out for more. So there was a benefit for people wanting to do that. There's some people that don't like the frank dividends, so a couple of people switched to loans so that they had a direct expense line for their personal financial planning. So yeah, it really just added flexibility and just made the company more likely to get new people interested and involved in it, because we had people serving different purposes and allowing different personal financial planning positions. I'd say the loans in are completely different to the equity, because essentially the loan in, we've just done one for 250,000. It's great for equity holders because that is a discount for corporation tax, so it pushes the yield up. And for the loan driven holder, it was far faster way for them to redeem the money if they want to use it for something different, 3 to 6 months. It's set up with a fixed interest rate with a call period anywhere between 3 to 6 months, depending on my negotiations with Sam. And yeah, just acts competitively in that it runs about 0.7, 0.8 above what a same 90-day notice account would get. And just delivers a fixed interest payment to the person, nothing dividend related. So as I say, different style of investment return. And yeah, we've got a cap 50-50, but I'd be hugely surprised if we get any bigger than 10% of loans, if I'm honest. So equity still is the default option for people coming in.
Cool. Just kind of straying more into Mark's sphere than my own, but just to wrap up, just a reminder of IHT. Obviously, that changed a little bit in the budget last year. So as an equity investment, Summerwood Place should be business relief qualifying. The business relief changes in the budget mean that only the first 1 million receives 100% relief. After that first million, it's 50% inheritance tax relief. You could do rights issues for new shares and it still have the same starting period. And it allows the ability to build that asset as actually free through either reinvestment of dividends or through other methods. And also it could be transferred into trustee equity. So therefore that could be excellent for long-term bloodline planning and a couple of areas like that. But that's more Mark's sphere than myself. So yeah. Jess, I think that brings us to an end for today. And Mark needs to go get his flight.
Lovely.
Yeah, I might have to sign off and I'll leave Sam for any questions.
That's great. And as usual, guys, we will send out the presentation and the recording as well to anyone who signed up to the webinar. So if off the back of that you do have any questions, then obviously please do reach out to the guys. Otherwise, we will see you at the next quarterly update or our next webinar. Look out for the invitation. We'll send those out as soon as we can. Thank you.